Focus. Ideate. Innovate. Enable. KPMG and CNBC-TV18 present Budget 2023, The Fine Print.
Hello and welcome to this special program. This is KPMG and CNBC-TV18 present Budget 2023, The Fine Print. I'm joined by three very special guests to discuss the taxation fine print associated with Budget 2023. Let me introduce the three guests right now. Parizat Sirwala is Partner and National Head, Tax Global Mobility Services at KPMG in India. Simachal Mohanty is Head of Global Taxation at Dr. Reddy's Laboratories, and Naveen Jain is Tax Director, Asia and India at Diageo. Thank you very much, all of you, for being with us here on this special program. Parizat, if I can start with you with, I think, what is the maximum interest to the maximum number of people watching this program, personal income tax regime, old versus new. How should one think about this? And is it as clear as day and light in terms of which one should opt for, or it depends on which income bracket you fall under? Go on.
2 years back, the finance minister had very clearly laid out her stated intent by coming out with an optional tax regime, on the lines of the corporate tax regime. And even if you read today's interview, the intention is very clearly to move to a lower tax structure as far as personal taxes are concerned as well, but kind of do away with, the exemptions and deductions. That seems to be the intent going forward. Having said that, the scheme that was introduced 2 years back did not find many takers because it did away with most of the exemptions and deductions that individuals were very popularly used to, for example, our common ATC deductions, interest on housing loan, HRA, so on and so forth. So it did not have any takers. With an intention to nudge the taxpayers towards availing this new tax regime, it has definitely seen some changes and it has become more attractive. However, the question that remains, as you asked rightly, is that while there have been changes to the slabs, for instance, the basic exemption limit under the new scheme has now gone up from 2.5 lakhs to 3 lakhs. The tax rate of 25% has been dropped. There is a significant change. So income earners up to 7 lakh rupees typically, by virtue of a rebate, will now not land up paying any taxes, so on and so forth. Surcharge has been dropped on an income above a particular threshold. But to your specific question as to what is the break even, as an individual taxpayer, as a common man, where do I know which scheme to go under? Because the old regime has not been touched as yet, and they have given the option to continue with it as yet. Well, that is a function of your gross income and the amount of deductions that each individual is claiming. So it's going to be very dependent on your individual position. But just as an example, if the rough and ready maths seems to indicate that if you are somewhere in the income levels of 7.5 lakhs to 15 lakhs per annum, and if your annual deductions, which you're claiming, whether it's HRA, whether it's ATC, etc., is to the tune of around 1.6 lakhs per annum to 3.7 lakhs per annum, 7.5 lakhs per annum. If you're more than those deductions, then you may be better off, more tax advantages under the old scheme, so on and so forth. But let's say for higher income above 5 crores, the new regime now definitely looks attractive. So it's going to be, Prashant, the function of, without being too complex about it, it's actually right now going to be a function of the amount of deductions that you're claiming. Having said that, even in today's interview, the finance minister has sought to clarify that there is a strong push towards making this new regime as the default regime going forward.
Got that. Now, Naveen, could you help us clarify the revised surcharge rates under the new regime, new tax regime? What do you think is the reason for bringing down the surcharge rate from 37% to 25% for individuals having income above 5 crores? There is also some messages in social media going around that 37% surcharge still remains in the old regime. Is this correct?
I think it's a very relevant question, Prashant. As Parizad said, the stated intent of the government is to do away with the exemptions and make the new regime as the popular regime and de facto regime. And therefore, the benefit of reduction of surcharge from 37% to 25% is applicable only for the taxpayers opting for the new regime and not for the old regime. As finance minister stated on his speech, that the current personal tax rates are on the higher end as far as India is concerned, and the maximum rate of 42.744% has been now brought down to 39% due to reduction of the surcharge from 37 to 25%. And as Pari also briefly mentioned, that if you're in a say 5 crore bracket and above, and that effectively means that 3.744% of 5 crores and above is the tax advantage you get by opting under the new scheme, and looks like that's going to be lucrative. That's it from me, Prashant.
Right. Got that. Naveen, the other thing that I wanted to check with you, what according to you exactly is the impact of the changes on the rollover tax exemptions under Section 54 and Section 54F? Can people trying to sell long-term assets and claim exemption of capital gains do it before March 31st, 2023? As the changes in Section 54 and 54F are effective from next year. Is this understanding correct according to you?
Prashant, just to give you the context, Section 54 and 54F, if you have sold a long-term capital asset, any capital gains or net proceeds from the sale of the long-term capital asset, which could be a residential house property or other assets like shares, if you invest those into another long-term capital asset being a residential house property, you get a deduction and your capital gains are not subject to tax. Now, as the finance minister stated, and it was also mentioned in the memorandum explaining the finance bill, that the intention of this deduction was to encourage the housing sector and provide impetus to the new construction activity. However, it was seen that some of the high net individuals were actually buying and claiming huge deductions on account of investment in the new house properties, which was exactly not the purpose for which those exemptions or deductions were brought in the statute. So the purpose is to restrict those deductions to 10 crores, and therefore any gains over and above 10 crores will now be not entitled to deductions and will be subject to capital gains. However, this will be only applicable from financial year 23 and 24 onwards, which effectively means any gains on account of sale of the long-term capital asset before 31st March 2023, the taxpayers can still avail the benefit of the current provisions under the law.
And Naveen, do you think this is significant? Because a lot of viewers have kind of written into us saying, basically saying how many people will fall under that category of being able to realize that kind of gain by sale of long-term assets, etc. And of course, the question of how many properties are there on an aggregate basis. In cities like Mumbai, etc., it will be there. So I'm just trying to understand, is it very meaningful as a change?
See, this is meaningful in terms of the intent of the government, that the intention to do away with the exemptions or deductions. And, you see more and more in the fine prints of the finance bill that if the purpose for which a section was brought in is not serving that purpose, the government is not hesitating to amend and clarify that intent. And through this amendment, a significant message has been given that if you're making gains through sale of shares or through some of the other long-term capital asset, then capital gains tax should be paid to the government, and any gains over and above 10 crores will not be protected, and tax has to be paid.
Okay, plugging the loopholes. I mean, use it for what it was intended. So a lot of that getting done. You know what we'll do is we'll take a quick commercial break at this stage, but stay with us. You're watching KPMG CNBC TV18 Budget Fine Print 2023. We are back after this quick break.
KPMG and CNBC TV18 present Budget 2023, the fine print.
Welcome back. You're watching KPMG and CNBC TV18 present Budget 2023, the fine print, and we're in conversation with top tax experts. Simachal, let me come to you now with a quick question. It appears that interest on housing loan will not be allowed to be claimed twice now. Once as deduction from income from house property, and secondly, as cost of acquisition improvement on sale of property. Does this mean that the taxpayer, as a taxpayer, I have a choice as to when to claim this?
Let me divide the question into two parts. The position that is prevailing until now and the position that is going to prevail beyond FY23, that is next year. So until now, the taxpayer was giving three types of treatment in its tax return. One, as you rightly told, it was the taxpayer was claiming 2 lakhs as loss from house property towards the interest deduction. The other treatment the taxpayer was also giving is claiming this as part of Chapter 6A. The third type of treatment the taxpayer was giving to claim this as part of cost of acquisition. However, some of the taxpayer attempted to club two benefits and make a double deduction. So in order to curb this kind of practice, the budget provision proposes then a taxpayer cannot avail both interest as a deduction under Section 24 as well as a cost of acquisition under Section 48, which means a double deduction is denied. And at the same time, let me speak about what is going to happen way forward. So way forward, there can be two types of taxpayer. The taxpayer who are going to go to new tax regime or who are availing the new tax regime. The taxpayers who are going to embrace the old tax regime or already there in the old tax regime. For the taxpayer who are there in the new tax regime, for them the choice is simple because they'll not be entitled to avail the interest deduction under Section 24 or Chapter 6A. So they have to definitely have a treatment that is available to them to capitalize the interest as part of cost of acquisition. The taxpayers who are there under old tax regime, so they have a choice now either to claim the interest under Section 24 to the extent of the limit available under Section 24, that is 2 lakhs, and balance amount they can capitalize as part of cost of acquisition. The taxpayers who are going to treat this as part of cost of acquisition, and if they're reporting this as part of their tax return, as part of ITR 2, ITR 2 is applicable for those taxpayers having more than 50 lakhs taxable income. So every year they have to show the cost of acquisition, including the interest. So effectively, every year the cost of acquisition is going to be revised as the interest amount gets added every year.
Simachal, there is a fair bit of discussion on is the changes in insurance. A viewer has asked this question, so I'm going to kind of paraphrase the question. The viewer says that I'm currently paying premium of less than 5 lakh rupees on each of my endowment insurance policy and have 4 such policies. Should I be worried about the taxability of maturity proceeds? And how is the premium threshold for this to be calculated?
So as far as the current policies are concerned, there is no issue because the proposal that has come in the budget that is going to be applicable in respect of those policies which are issued after 1st April 2023. So currently the only provision that the investor has to satisfy that the insurance premium has to be less than 10% of sum assured. In that case, whatever proceeds he gets, then that doesn't get taxed. That is the current position. Going forward, an additional condition has been imposed, saying that it's not sufficient that 10% of sum assured have to satisfy, have to also satisfy the another condition. The insurance premium per se, per policy, shouldn't exceed 5 lakhs in any of the previous year during the currency of the policies. Now coming to the treatment of multiple insurance policies. So the provision, the seventh proviso that is planning to get introduced in section 1010D, it states that the exemption up from the maturity proceed can be availed provided the policies premium which are getting matured, the premium from those policies do not exceed 5 lakhs in aggregate. So there are a lot of interpretation going on with regard to this aspect. So one of the view that is coming out, because a similar provision was there for ULIP policies, which is a part of the existing 1010D section, and there is a circular issued by the government in Jan 22 stating that the limit of 2.5 lakhs, which is there for ULIP, that is a kind of premium kitty an investor in insurance policy can avail, a policy buyer can avail for all the policies put together. It is not a particular policy for all the policies put together. However, there is no such circular clarification is there for the insurance policies that is inserted in the proposed budget. So in that context, I think we have to wait and watch to see what kind of circular clarification comes from the government. And until then, we have to take a stand, that we can follow conservatively the ULIP circular, saying that this 5 lakhs policy, the 5 lakhs limit is applicable across all the policies.
Paraghat, if I can come back to you, there was another thing which I think was being discussed, that the increasing the TCS rate on overseas store as well as remittance of funds under the RBI LRS scheme. How do you think this will impact individuals who have, for example, children studying abroad?
Yeah, sure. So, in fact, from the various post budget interactions that the FM and her team have had, they have indicated that it appears that there was a real concern that individuals were emitting huge amounts of money under this LRS scheme for various purposes. And to quote some of the articles today, as stated by them, is that they were buying properties in Manhattan, investing in overseas stocks, foreign stocks, sending huge amounts of money for children, whereas the tax returns were not very reflective or commensurate. The income levels or the disclosures were not reflective of these huge amount of outbound remittances on the LRS. So there was a concern there, just in terms of context setting, behind this provision. Also, from a balance of payments perspective, perhaps they've seen a large outflow of foreign exchange happening. So, what they have done is in this TCS provision, which is tax collected at source, they have significantly hiked up the TCS from 5% to 20% for the LRS payments. So, the education and the medical payments continue as it is, it does not apply to them. So, if you're paying tuition fees for children directly, then that's not within the ambit of this enhanced TCS provisions. But any other expense, as an example, for children studying overseas, whether it's living and subsistence expense or any other items of LRS which you're sending abroad for overseas properties or any other investments of foreign stocks as permitted by FEMA, it's almost a 4-time jump from 5% TCS rate to 20%. And earlier there was a ceiling of 7 lakhs. So above 7 lakhs it was triggering. Now that threshold, at least for LRS, has been removed. And so is the case for overseas tour packages. But, the TCS rate has been significantly hiked up.
Just to wrap this up in a very brief way, if I can come to the three of you for quick comments. I mean, is there a direction in which we are going from a taxation perspective? Parisa, let me start with you.
I think, as I said, in the backdrop of inflationary pressures and, not to put a dent on the purse strings of the individual taxpayer. There have been some significant changes to put more disposable income in the hands of taxpayers, which will hopefully, give a spurt to the consumption and the spending pattern as well, which in turn gives buoyancy to the economy. The trust is definitely on, if you see the slew of reforms, the trust seems to be to move towards the new and the simplified tax regime with, lower tax rates. And I thought some, bold moves in reducing the surcharge rate, the peak rate of 37 to 25, as Naveen said, because it was high time and because the top rate of India really used to hover around very high relatively compared to other countries. So all in all, should hopefully make individual taxpayers with some more, spendable income this year.
Naveen, would you agree? Any additional thoughts?
No, I think I totally agree with Parizad said. We are going to have less and less deductions and exemptions as individual taxpayers, and the encouragement will be to opt for the new regime. But I also see a trend where the government is monitoring all that you're spending and the information which is being captured in your annual information return. So there is going to be more and more focus on tax compliances and TCS as a mechanism to track the expense that you do and match it with the income that you declare to the authorities.
Right. And Simachal, you want to come in with, your thoughts?
The taxation regime is actually heading towards the simplification and transparency because government is promoting the new tax regime. So by promoting that, we are going to have a lot of advantages. One is the simplification, simplified tax return, simplified tax structure, as well as there are no deduction and no litigation.
Well, thanks very much, all of you, for joining us on this special program and help us understand some of the fine print of Budget 2023 from a taxation perspective. While you were watching, KPMG and CNBC-TV18 present Budget 2023, the fine print. Thanks very much for staying with us.
KPMG and CNBC-TV18 present Budget 2023, the fine print. Focus, ideate, innovate, enable.